Welcome back, traders and investors. We have a very special guest today. We have Chris Banyai of Banyai Wealth Management. Chris, welcome to the show.
Good morning, gentlemen.
How's it going, Chris? And I have a lot of history, and Joel has a lot of history here with Chris, too. I've traded with Chris for the better part of a decade here. We were traders at Bright trading together from 2003 till over 2010, and now Chris is trading on his own. He's moved on to options. I'm still I play in the options with him a little bit, but I've stuck with equities. But Chris has moved almost entirely on to options here. But first, Chris, just give us a little bit, of your trading background there, and obviously your education as well.
Okay, well, I graduated from the University of Windsor with a finance econ background, and a few years later I got my CFA, and I was a Bright trader from 2003 to about 2010, 2011, and then I kind of just branched out into starting my own little Banyai Wealth Management firm here, and I've kind of started with equities and kind of gravitated to options over the past few years after all the stuff that's been going on with the issues with day trading, with internalizations and all that business.
Okay,
Now,
so go ahead, Dennis.
I was going to say, and obviously you've moved on to options because you feel like there's more of an edge there. We've said it, and I've talked about it for years, that, it is difficult to day trade here nowadays. I always say on the show, scalping is kind of dead to us, where me and you, Chris, we used to be basically market makers on so many different stocks. We'd sit on the bid, we'd sit on the ask, trying to make the spread all the time, and now it's just so difficult to get filled on those orders. Is that kind of why you've moved into the option space?
Absolutely. If you try and get filled sitting on the bid or the ask, you still have those supercomputers that get access to the quote or the order feed before you do. So if they really want that position, in reality, you really don't have a chance to even get that position if you want it. You kind of you sit back, and if nobody else wants it, you're the guy who gets stuck with it, almost feels like sometimes. But when you really want a position, you're not going to, the probability of you getting it's very slim, right?
And that's exactly what happens, and that's why I put out a presentation a while ago on limit orders there, and that's what it's explaining, is exactly what Chris is talking about here, is you sit your limit order out there, and the problem is by using limit orders, and I'm not saying you should use market orders, but I'm always a fan of taking liquidity, like lifting the offer or hitting the bid, especially on liquid stocks where you only have to pay a penny, because if you sit there with your bid out there, basically, everybody queue jumps, they get ahead of your orders, and the only time you get filled is when it blows right through you. So it's kind of hard to be a market maker anymore. So you've had to adapt your strategies then, right, Chris?
Absolutely. Like where I would try and, we'd try and make markets, and, you'll be in some illiquid stocks, and you think that, wow, I'm staring at the tape, and orders just came by, and I'm sitting right here. Why did I not get hit? And after seeing that for time and time and time again, you just kind of start to realize that that's not the best game in town anymore, right? You kind of just got to start slowly adapting to new things. With options, you won't see that. You really won't get pennied in options because the option is virtually based on a calculated price, correct? So if you're sitting out there and you want to get done at that price, you may have not the right price, but since you wanted to get out at that price, you're going to get hit because things are based on a calculation. They got a fair value, right? Sorry, continue.
So have you been able to automate any of your strategies, or are you still pretty much, it's not, you're not necessarily staring at the screen? Do you have built-in filters or scanners that will automatically, when you're away from your desk? Have you been able to automate any of your strategies?
No, I really don't automate the option strategies, but I do run filters that will show me stocks that will pique my interest. And I'll always do a lot of research on my own, trying to see if there's a turnaround story or something along those lines that or an activist investor came in, and that could give it a potential for a little pop. Like, I'm not looking to take a stock from 20 to 40. I'm looking to take a stock from 20 to 25 or 26, because when you make $6 on that $20 investment, I'm doing it through an option strategy where I can take that from $1.50 option to $5 option. Do you know what I mean?
Yeah, so you're looking at it, and that's why you're using the options to get the leverage. And what you've
Yeah,
done mainly there too is extend your time frame. Like you went from this whole short-term trading, market making to pretty much swing trading, correct?
absolutely, absolutely. Yeah, I find you have higher probabilities with having a longer time frame. So I'm looking to say have an option position for 6 to 8 months or longer.
Oh, so you're really holding a long time sometime too. And when you're picking a strike, like how do you, so let's say you get this setup that you want, the fundamentals are lining up, your technicals are lining up. How do you go about picking your strike? Like what do what's your methodology for that?
So say for example, a stock is trading at $16. I would be looking at the 1750 strike.
So you're
And
taking something slightly out of the money?
Yep, absolutely. I'd never go on something in the money. Like I would never be trying to buy the 15 strike. I'd be trying to buy that 1750 strike, knowing that, I have reasoning to believe that it's going to go to 1750 and higher, right?
Okay, so you made the transition from trading just stocks outright into options, and you talked about the leverage and different things of that nature. What was the process? Did you pick up some books? Did you learn the old fashioned way? How did you make that transition?
Well, at first, it was that transition between stocks and day trading, correct? So I kind of realized that game in town was kind of drying up. So I started dabbling in with stock trading for swing trades, but I found that just wasn't for me, right? Like, here's a situation for you. Say you put $30,000 into a stock, or you can buy the equivalent of that with $1,000 in an option position. That's dated for, I don't know, 6 months, 8 months. Now you wake up tomorrow and some news hits and that stock's down 25%. So you lose 25% of $30,000. With having that option position, you may just get that $1,000 wiped out. So that's kind of my rationale for being less in stock and more in options.
So you're managing your risk better by using options than you could when you were day trading. Because the difference is when we're day trading, we're in and out during the day for the most part. We don't have a lot of overnight risk. When you're swing trading, you have a lot of overnight risk, obviously. And by moving to options, you find a way to limit your overnight risk in that way, like the risk of news more than anything.
Absolutely. So where you can, and the big kicker about it is that now that you've gone to swing trading versus day trading, it's a capital intensive environment now. So you need the capital to make the capital.
Right.
So through options, you can spread that capital around a lot better than instead of buying $1 million worth of stock, you could have $3 million worth of exposure through options. You know what I mean?
Correct. Are you now? You're talking a lot here, and from your responses and stuff about buying stocks and buying the calls and stuff. Do you use your traded strategy in reverse? Obviously, we're in a major bull market here, but if you're accurate at picking stocks that can go up, are you also scanning the universe of stocks for shorts to diversify your portfolio a little bit, or are you just kind of a person that's leaning with the market? The market's going up, you're just going to play the long side.
I would say right now, I wouldn't do as much trying to hedge the portfolio. Every time I've ever tried to hedge a portfolio, it seems to always just blow up in your face in the end. I would say move more to cash and just have less in the market. If you start to have that feeling that the market's going to start, having a short-term correction or pullback, like right now, like after being up this high, I'm probably 30% in cash versus at the beginning of the year being maybe 10% in cash, right? But I would start scanning the universe to put short positions on just how I'd put long positions on. For example, the mortgage refinancer NSM, OCN, and WAC. Recently, it was a bullish to bearish scenario where these things couldn't make enough money. They kept making money and money and money, and all of a sudden, one came out and just blew up. So I put positions on the two that I've been following. So I had already had these positions on bullish, and I had taken them off throughout the year. And then after I saw that one report come out, interest rates going to go higher and stuff like that, I'll start putting on puts like that. But I'm not going to go out of my way to start looking for puts now. Not yet, anyways.
It sounds to me like what your whole strategy, like with the option strategy, is you're trying to eliminate the noise, really. Like you're getting an opinion on the stock where you have a fundamental opinion on whether this, company is going to outperform or underperform. And then you're trying to put up, a trade on it out 3-6 months out. So you're basically, making a fundamental opinion on the stock, probably using a little bit of the technicals to maybe time it a little bit better. And then that helps to eliminate the noise because it's, high frequency trading, day-to-day chop and all this other stuff. And do you find like, in this 3 to 6 month time frame that does help you to hold the positions better?
Absolutely. If you put a position on for 4 months, 6 months, 8 months, you can handle that 20, 30, 40% drawdown in that stock position and still have the exposure to it. Anything can happen in that time frame. You could have a takeout, the company may have had just one bad report and the next quarter they come with a great report. The best situation I probably could analyze that is that with the solar companies. About 6 months ago, they were unbelievably hot. And then they hit a rut and they all tanked maybe, 30, 40%. And then, it came all the way back. And I had positions I had put on in SunPower and First Solar and Sun Edison 6-7 months ago. And I've had the exposure in them. And then, they've came all the way back. They really, I wrote them off. Like they just sat there in the portfolio and I said,
These were options for you, yeah.
Yeah, nothing's going to happen there. I'm just going to eat it. But then, it starts getting hot again, and next thing you know, they start taking out new highs, and they all turn into profitable positions.
So you basically had all these option positions that you had put on, for $1 or $1.50, and you had just basically said, well, I'm going to lose those dollars on all these option positions. They're not going to work out. But you actually didn't liquidate them. Rather than sell them at a nickel or a dime, and you hold on to them, and they're almost like little lottery tickets down there. And if something does eventually turn around, those things that you basically said, well, I'm already, those are probably dead money, can eventually turn around for you sometimes, and those little lottery tickets really worked out here in the case of the solar companies.
Absolutely. And you'll put a position on, and I'm never going to try and hold something to have a 10 bagger on it. Like I'll put a position on and I'll scale out, it's up double, it's up 2.5, it's up 3, it's up 3.5, and I'll scale my way out of it. So I'm never looking to hold something for expiration and hope that it gets to I'm not setting a price target. I'm just getting out profitably, right? So when you'll keep continuously rotating positions and you'll get out of stuff. It could be a week, it could be a month, it could be 6 months, and not those solar stock situations, but you're continuously rolling, right?
With the solar stock situation here, now you put on the initial position, and it went against you a considerable amount. And you didn't liquidate, but in those situations, are you still firm in your convictions? It's a golden rule, don't frown, average down. Are you tempted to do that if you own a bunch of options at 20? The price goes to a nickel. You're still confident in your position. Will you pile in and try and bring your average cost down, or do you just say, hey, I took this position, it's going against me, I'm just going to sit it out and ride it out?
Eventually, it all comes down to how much I think that it's going to work out. Obviously, some positions are going to have a little bit more risk than other positions. But a perfect example, Santeris, a pharmaceutical stock.
This symbol on that, Chris?
SNTS, Sam, Nancy, Terry, Sam. This was, I'm big on looking at the fundamentals. I'd call myself like a techno analyst, I guess, techno fundamentalist. And I look at a lot at the quarter over quarter growth in sales and EPS. It kind of gives you the true meaning of a growth stock. So it kind of really tells you how growth is happening in a company. Like, you don't look at it beating consensus for the month or the quarter. That's just numbers guys put together. It's based on the company's growth, right? So this company was amazing, kept growing. It's growing sales at 60, 70% quarter over quarter, EPS 100% plus quarter after quarter. And it got in a rut. Like, it got up to 28, sat there, got all the way down to 20. And I was convinced that, it's going to put out another good quarter. It's going to put out another good quarter. So you start buying it gets down to 20. It's just at 28. You're buying the 25 calls for $1.85 short term, like for the next earnings report, so November. So plus you have positions on it going into on top of that. And next thing you know, they come out. I'm waiting for earnings reports, and they get bought out by Salix Pharmaceuticals for 32 when it was trading at 23. So that's a situation where I was convinced that it was going to put out good numbers, and it still put up blockbuster numbers for the quarter, but it got bought out at the end of the before it could even report the numbers. So it's stuff like that where if your conviction is high enough, then I'll add more aggressively to positions, right? It doesn't work out every time, but usually, you want to put your money in the best of the best, right?
So I like that term that you use, techno fundamentalist. So you identify the fundamentals in a company. How much attention do you pay to technical analysis? Do you have some favorite indicators that you like to follow? Obviously, you're doing some longer term trading. So once you've established your fundamental opinion on the stock, how do you translate that into the technical analysis?
Well, my favorite way to look at, I've obviously considered myself a techno fundamentalist, but I'm looking for solid growth companies, not really momentum companies. I'd throw like a Tesla or an Amazon, or, when you got to start coming up with metrics that aren't earnings or revenue to say that the stock should justify that value. I want to know the EPS and the sales growth, and I'll look at a quarter over quarter basis. So I'll look at the past history of the quarters, probably the last 4 quarters, and then I'll look at the next 2 quarters. And based on the trend of the growth in earnings and revenue the past 4 months, if they can have an attempt to really crush the numbers the next 2 quarters, then I'd be willing to put money to work in options for 6 months to a year. And then I'll sometimes just buy the call that I want to purchase that's out of the money. And if things aren't working out, sometimes I'll add to the call, and sometimes I'll put a leg on of selling a lower put. So I'm convinced that from what I'm seeing, that things are going to take off. It could be this month, next month, 2 months, 3 months from now, but usually the best case scenario is when things line up where the fundamentals are peaking right when the graph is trying to break out, right? Like, you'll see the buyers come in with volume spikes and stuff like that. And if you get a solid breakout with that fundamental background, then your probabilities are through the roof on that trade.
So you are looking at the technicals and trying to time it. So when you see that all, where a stock consolidated for a bit, but it's been moving higher. I know you're always a big fan of, like, you're not afraid to buy a stock when it's making a new high, right? Like, a lot of people are very
Absolutely.
hesitant to come in and buy stocks when they're making new highs. They like to come in and buy stocks when they're making new lows. And I know, and you've actually helped me, through that too, where I've always been a fan of buying low, selling high, but you're kind of like a buy high, sell higher guy, right?
Absolutely. Like, people don't realize that when a stock breaks out to a new high, there's no previous remorse up there. There's nobody that, bought up there and had to fall off and get back up there, and they say, I got my money back, I'm out. It's all fresh buyers as soon as it hits a new high. So that thing could go 5% and stop, could go, in the case of Tesla, it went hundreds of percent higher. Like, there's nobody else there. there's nobody to stop it from going higher until either the market turns hard or the buyers dry up. But it's free run. That's why I look at this market right now, and people want to start calling tops, and it looks toppy, and we're in a bubble. The reality of the situation is it's all fresh buyers taking this higher. That's key. There's nobody there to sit back and say, okay, I've felt the pain. I got my money back. Let's tap out. It's all fresh. So that's the key, right?
Now talk about your Tesla trade, because you mentioned this for a while. I know you were telling me, and you were all over this Tesla, and I mean early. When were you starting to first buy options in Tesla?
I was starting to buy options in Tesla. Probably it broke out above 40.
40
Now,
$40. So you're going back to when was
I
this?
remember that $40 level, and that thing held up. I don't know if we can pull it back on the weeklies here, if it will give it, but I remember that level. It just kept hit. When was that? That seems like it was forever. I guess if you go on the weeklies here, not too long ago, it was back in April on the daily charts. Man, it was hitting its head against that thing. I don't know, 6, 7, 8 times.
Oh, absolutely. And it stayed in that range ever since it came IPO, right? So it finally took out its first range on 664% above average volume.
And that's when you start looking at it, when it starts breaking out to new highs.
Yeah, that caught my eye in the trade. Okay, and lucky enough, it drifted down to like 41, 42. And I started starting to do my homework on it and looking at it. And the best case scenario is when you can get positive uncertainty in a stock. So you got Elon Musk coming out, and he's starting to tweet, it's looking scary in Shortsville, and like we're going to produce our first profit at this quarter and stuff like that. And then he comes out and says, I'm going to come out with a new tweet every week for the next 6 weeks or 8 weeks or something like that. So I saw all this coming together, and you're starting to get some chatter in it. So I'm starting to, it's at 40, 41, 42. I'm starting to look at buying 50 calls, 60 calls, spreading it, going long-term out a year and putting on $25, selling the 25 puts, buying the 60 calls and selling the 85 calls or something like that. So I'm trying to attack it from as many angles as I can, as cheaply as I can, with the least amount of exposure as I can. So lucky enough, they came out with earnings, pops. I'm liquidating as soon as it's hitting between 70 and 90. And I look back and it's probably the best trade of the year, and it's probably the worst trade of the year at the same time, right? It goes up to 200 eventually.
Yeah, if you would have been holding it, you'd been retired.
Yeah, exactly.
Yeah, but still, wow, that's impressive though, Chris. So what is on your radar now? Like, you've had these Tesla trades and you've had some great trades, and I know you've had a great year trading here. What's on your radar right now? Like, what is the next Tesla here for you? Or maybe not the next Tesla, but the next hot stock.
You look, and it's hard to, I would say this, a situation like that Tesla where the stars kind of align, that maybe come around once every 5 years in that situation. But by casting this wide net and having a bunch of positions, you can get
how many positions would you have on? Like, how many, like, I know you're like a hedge fund man. How many positions would you put on or have on right now? Like,
I've probably got maybe 70 or 80 positions on.
70 or 80 positions on. So you're massively diversified too.
Yeah, but I would say, like, I'm always looking up on earnings reports. I believe a lot in the post-earnings drift. So basically, either the market is going to move a stock, or the company is going to move a stock. So you got a market right now that I personally don't think we're going to start crashing, and I personally don't think we're going to go to the moon. I think we're going to stay in this area. Maybe bounce around 50 points up or down for the next, month or two until, you get the government stuff dealt with in January. So that is a safe enough environment to start looking at post-earnings drifters. So you get a company that comes out, beats top, bottom, raises guidance. Like, to me, that is a situation where unless something terrible happens with their company, they get hit with a lawsuit or something, or they're making defective products, that thing's going to drift higher for a bit. So I'd say a perfect example of that is Nu Skin, NUS. So these guys make they're very big in Asia with women's face creams and stuff like that, or cosmetics basically. So they just came out, and even yesterday, so they guided high, they beat top bottom, guided higher at the earnings release, and just came out yesterday. I think they had an investor meeting or analyst meeting or something, and they raised on top of that. So I think I was telling Denny there, they were lucky enough, the day that the earnings came out, it went from 100 to 115 all the way back to 102. So that was like, you don't really usually get situations like that to be able to put on a lot of stock when you know that it's a great stock and company when it pulls back like that. So when that situation happened, I'm starting to load up on that at 102, 103, 104, 105, just in options, not buying physical stock. So I think I bought the call, the 115 strike for that month. Like I said, I usually will not do day trades. Like that's what I'd consider a day trade, like maybe doing the monthly call or monthly option. So I think within 3 days that thing was back at 115. Now it got up to 122 or 121 yesterday. So this all happened within a month.
Are you just get your opinion here? I mean, you got the new IPO on the Twitter. I know you used it to your advantage with the Elon Musk and Tesla trade. We've had this thing open for almost a couple weeks here. Pretty good ranges. I know options just started trading on it. What's your outlook for shares of Twitter?
I think with Twitter, you got to kind of go right back to the Facebook playbook. Basically, everybody and their mother had an opinion on Facebook. It's the next great thing. It's terrible. Everybody hates it. No one's looking at it anymore. And it really, you could have bought it in the early stages the first month and got destroyed. Bought it 4 months later and made a killing. But the proper time to get in that thing was when they came out with that earnings crush. That was the game changer. That was the inflection point. And that's kind of what I think you got to do at Twitter. I think, it could have go up to 50, it could go up to 50, it could go down to 20, it could go down to 20. But in the meantime, I'm going to sit back and I would wait for, concrete evidence of that it's going to make some money, right?
Okay, so final tips here, Chris, for everybody, because you've been around the block. You've been a prop trader. You were a prop trader for 7 years. You're now kind of running your own options trading firm here now. What are your tips out there, for traders who are just starting here, and what do you think, they should look out for?
I would, if you're stuck in a rut and you really can't get anything going, I think it's never a bad idea. Like I did a lot of reading, and I still do a lot of reading, and I believe in it. Like I feel like you should always be doing research. I think you got to invest in yourself. I did a lot of reading of trader interviews. So read a lot of the Schwager books, and there's a bunch of other books out there on interview traders. And as you read all these interviews, you start realizing that there's some strategies are timeless, right? You'll see guys talking about the same thing in a slightly different aspect, but there seems like they're talking about the same stuff. And it's a lot to do with trend following and stuff like that. You got to etch out your own type of strategy with the main types of core strategies like that. So I would say, get some idea generation going. Don't quit, and don't be afraid to venture into new things. I ventured into options, and it took me a while to figure it out, but it seems like everything's on the up and up now. So don't be afraid. Get in there. Don't quit. It'll come around.
Okay, so we're going to close out the interview. I know you and Dennis were in the trade cave during the financial crisis or anything. And
there'd be some good stories there.
Yeah. So we're going back and forth here. I mean, could you just give us your favorite Dennis trading story real quick?
Let's see.
Put him on the spot.
He almost set the house on fire one time. No, I'm kidding. No, it was a lot of good days. You got in that groove where sometimes just felt like you couldn't do anything wrong. So it was some of my best memories I've ever had, going and getting in there and having a good time and day trading and making markets. And there's no real crazy stories, just a
You
bunch
know what
of
was
good
crazy,
times.
Chris, is that financial crisis, though. Like, talk
Oh
about
yeah.
how we were trading during the financial crisis. And I tell you guys, 2007, 2008 blew away. For me and Chris, those are the best trading years of our lives. I've been a prop
Oh
trader
yeah.
since 99. And it's good. And Chris has really found something with the options here now. But that 2007, 2008, it was unbelievable, the trading. People were just throwing everything out. Just unbelievable.
It
Just
was
talking about
it,
some of those days, man.
it was a pair trader's wet dream, is what I would say. It was the most. If you had pair trading skills, like, you could have just. It was unbelievable.
Because
Yeah.
relationships were just getting thrown out the window. People were
Yeah.
just like selling stuff, and I just sell it and don't even worry about where you get out. But there's relationships there, real relationships there between stocks that hold in the even in the short run. And they're selling stocks, and you could pick up something and sell a similar asset, and within minutes, you're back up in the thing. So we were kind of just playing a market making role back then, and just really cleaning up from it.
Absolutely. When you have all these financial stocks, and you've got the major banks, they've all got 15, 20 other types of stocks out there, whether it be
Birds, yeah,
preferred stocks or like structural management
wow.
assets. Like, you see the parent company trading down 15%, and you see some of these that are the exact same company, exact same assets, everything, sitting there flat on the day. Like, some stuff was just a no-brainer, right?
Remember the Bear Stearns and the Fannie Mae plays we had? Like, we had a
Oh,
few
wow.
where Bear Stearns had went from like 180 down to $80, and its preferred stock. I remember this one. We just loaded up in it. Was still sitting there flat at $25, and I remember even saying to my wife, I was like, you know what? With Bear Stearns, I remember saying, I don't know if it's going to go bankrupt or anything, but is it possible that there could be some serious problems here? And this is before the financial crisis started. We're talking like May or June 2007, and me and you just started shorting that Bear Stearns preferred F flat. I was like, our risk was like 6% or 6.5% because that was the coupon on the thing, and I'm like, there's really no upside because it's trading at par really now, 25. So I mean, there's really the downside really was the risk of paying the coupon at 6.25. But I'm like, what if there really is trouble here? And then what was it, like 2 or 3 weeks into that trade, Bear Stearns just collapsed, and we just collected on that.
Oh, yeah. Just unbelievable. And, the confidence that we had, like, there's 50,000 shares on the bid. I'm taking 25. You're taking the other 25, and,
Yeah.
and then you'd move on to the next.
Yep.
There's 30,000 shares there. I'm taking this many. Do you want them? If you don't want them, I'm going to take more, and you'd say the same thing to me. And next thing you know, we're just short the financial world, unfortunately. Like, I don't want to say that I contributed to all that and all whatnot,
Well,
but,
we didn't
it's
contribute
just,
to it, but we definitely profited from the
yeah,
idiot,
absolutely.
the how basically the subprime and the financial crisis. Like, the banks got
Absolutely.
over levered in that, and we took lower risk bets on them. The commons were collapsing, but the preferreds were lagged. They lagged, and we got short. Fannie and Freddie, we were short a pile of preferred stocks, and it took a few weeks into the trades, but those things eventually paid out big time.
Absolutely.
So, and that's what it is. It's all about finding those different opportunities. And when you do find something, that you're pretty confident in, just strike hard. So, and Chris did very well with that.
Okay, I know you guys are getting close to the open. Get ready here. Chris, thanks a lot. That was a great interview. We'd love to have you back on again, and have a good training day, a good weekend, and thanks for coming on.
Thanks.